Deckers Outdoors, ticker symbol DECK, reported earnings here after the bell, and the stock was down 2.91% today. But after dropping those earnings, double-digit gains here for Deckers, up 12% on the news, and we're going to talk about it. We're going to talk about Deckers Outdoors, why they're rallying, the good, the bad, the ugly, what this means for the consumer, and is Deckers Outdoor a buy right now? But before we dive in, if you could please go ahead, like and subscribe. It really, really helps me out. Let's dive in. Now, for those of you that don't know, Deckers brands, designs, markets, and distributes footwear, apparel, and accessories. They operate through various brands, including UGG, Hoka, Tiva, and Kookaburra, and sell products through retail stores, e-commerce, and wholesale channels. Their products cater both to everyday and casual lifestyles, as well as high-performance activities. And the company reported what was a very good quarter, beating by a wide margin on both revenue and earnings expectations, growing revenue 16.8%, growing EPS 23.4%. You can see right here an absolute massive beat. 900 million was the expectation, 964 million is what revenue came in. Looking at the quarter more granularly, you could see here that gross margins did decline, net income margins did decline. However, net income dollars actually increased ever so slightly. But when you look at EBITDA margins actually increased ever so slightly, and EBITDA dollars actually increased as well. And I think the market really, really loved to see this. Also, the company has a great balance sheet, $320 million in debt, $1.72 billion in cash, and all in all, just a very, very solid quarter, 16.8% revenue growth. Now, the cost of sales did increase. Again, that probably has to do with some tariff concerns, maybe just the higher cost of materials, but they managed to make up for that with SG&A by only increasing 10.5%. And that's why you were able to get some really strong operating leverage in the brand, growing net income 20.3% and earnings per share even more so thanks to the share buybacks that they do. Now, looking at the brand segments, you could see here that Hoka, their biggest brand, was the standout, growing 19.8% on the year to $653 million. UGG grew just shy of 19%, and all other brands actually fell 19%. So the real drivers of growth were UGG and Hoka. Wholesale was up 26.7%. Direct-to-consumer was up half a percentage point, but on a comparable basis, direct-to-consumer actually fell 2.2%. You could see that domestically, the US sales actually fell, but international, this is massive, massive growth, up 49.7%. And here is the Hoka revenues. You could see up 20%, very, very strong growth. I mean, you're looking at 8x growth in a matter of 6 years. Absolutely strong, strong growth. Now, the company also reported its guidance figures. So you could see right here that the company reported net sales of 1.38 to 1.42 billion for the second quarter. This is the fiscal second quarter versus 1.39 billion. That was the expectation. So you could see here the market was expecting this 1.39 billion figure at the midpoint. You could see here that the management team came out and actually beat the expectation. The same is true for diluted earnings per share. The market wanted 151. At the upper end, management said 155. At the lower end, 150. And that is why the stock was up 12% here in the after hours, right? And at one point, nearly up 20%. It's because the company reported a double beat and they actually raised guidance above the market's expectation. And the international segment growing 49%. The two big brands, Hoka and UGG, growing mid-teen, high teens, double digits. When you get that type of growth, when you get a double beat, when you get a raise in guidance, the shareholders are going to reward you. Now, the stock has suffered a lot this year. However, it does look like the management team are on the right track. So where does that leave us with the valuation of the company? Now, on a PE basis, the company trades at 20 times, a bit expensive for an apparel brand, but, growing at 20% clip, that's not expensive at all, below a market multiple. EV to EBITDA trading at 13 times and a shareholder yield of 3%. So this is how I like to value companies in aggregate. You know how we do it on this channel. So we take the trailing 12-month revenue and we're looking for about 8% growth sequentially to 2029 to see revenues of 7.4 billion in 2029. I think they can definitely see upside to those numbers, but we're being conservative and that's what the consensus expectation is. We are expecting EBITDA margins to grow. I think EBITDA margins have actually troughed out, and I think we can see 23% EBITDA margins by 2029. That'll leave us with an EBITDA of 1.724 billion and using a 15 multiple, which I don't think is crazy, right? Get the enterprise value, subtract the net debt, divide by shares outstanding, which should decrease by about 2% every single year. You then get a stock price in 2029 of $201. Current stock price is 117. They don't pay a dividend. So you're looking at about upside of about 11.53% compounded for the next 5 years. Fair value is about $114. The stock is at about fair value right now. So is Hoka a buy? I would say yes. You know, if you think that the majority of tariffs are behind us, and if you think the consumer only improves from here and the economy remains robust, the stock should do very, very well. Now, looking at the technical chart, you can see right here that there's a very, very strong consolidation zone after the previous earnings left a gap. I think what we're going to see over the next couple of weeks is probably a closure of this gap. So the stock's going to gap up tomorrow, and then I think we're going to consolidate and continue our way onward and upward to go ahead, close this gap right here. That is at about the $130 mark. So that's what I would say is the play right now. Tomorrow the stock should be up in the double digits. Wait for a pullback in the next couple of weeks and then maybe get in if that's something you were looking to do. Even analysts are a little bit bullish. You see the average price target is about $122. The max is about $150, which is well off the highs near the $200 area. But on the lower end, you know, it is an $87 price target. So there are bulls, there are bears, but the overwhelming majority of analysts are actually bullish. But guys, if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.